Welcome to Oraculum Accounting, Business and Financial Forecasting. In this module, we will understand how organizations use forecasting to anticipate future conditions and support decision-making. Business and financial forecasting involves analyzing past performance, market trends, and economic factors to estimate future sales, costs, cash flows, and financial position. It helps organizations plan ahead, reduce uncertainty, and make informed strategic decisions while supporting long-term stability. Role of forecasting in business decision-making. Forecasting provides a structured way to anticipate future conditions so that organizations can plan resources, manage risks, and pursue opportunities effectively. It supports decisions related to production, staffing, financing, pricing, and investment by offering evidence-based expectations about demand, costs, and market trends, reducing uncertainty in decision-making. Forecasting versus planning versus budgeting. Forecasting estimates what is likely to happen based on data and assumptions. Planning determines what actions the organization intends to take in response to expected conditions. Budgeting translates those plans into financial terms by allocating resources and setting targets. Understanding this distinction ensures better alignment between expectations and actions. Qualitative and quantitative forecasting methods. Qualitative methods rely on expert judgment, experience, and market insight, especially when data is limited or conditions are uncertain. Quantitative methods use numerical data, statistical tools, and models to project future outcomes. Most organizations combine both approaches to improve accuracy and reliability. Sales and demand forecasting techniques. Sales forecasts form the foundation of financial planning. Organizations analyze past trends, customer behavior, seasonal patterns, and market conditions to estimate demand. Accurate forecasting helps avoid excess inventory, production shortages, and missed revenue opportunities. Financial forecasting, revenue, costs, profit, and cash flow. Financial forecasting converts operational expectations into projected financial outcomes. It estimates future revenues, expenses, profitability, and cash flow requirements, helping organizations evaluate growth plans, funding needs, and efficient resource allocation. Scenario analysis and sensitivity testing. Scenario analysis evaluates different possible outcomes, such as best case, expected, and worst case scenarios. Sensitivity testing identifies which variables have the greatest impact on results. These tools improve risk awareness and help organizations prepare for uncertainty. Forecast accuracy, limitations, and common errors. Forecasts are not always accurate and can be affected by unrealistic assumptions, data limitations, or unexpected external changes. Regular review and comparison with actual results help improve forecasting accuracy and support continuous improvement. Forecasting techniques. 1. Expert judgment and managerial estimates. Uses experience and knowledge when data is limited, useful for new products or markets, but may involve bias. 2. Delphi technique. Collects independent expert opinions in multiple rounds to reach a consensus forecast, reducing individual bias. 3. Historical trend analysis. Uses past data patterns, trends, and seasonality to predict future outcomes, effective in stable environments. 4. Moving average method. Smooths short-term fluctuations by averaging recent data to identify underlying trends. 5. Regression analysis. Uses relationships between variables to make data-driven predictions, especially when external factors influence outcomes. 6. Market research and customer surveys. Gathers direct customer insights and market feedback to estimate future demand and preferences. 7. Scenario forecasting. Develops multiple possible outcomes to prepare organizations for uncertainty and changing conditions. 8. Financial ratio, percentage of sales method. Estimates costs and expenses based on their historical relationship with sales, commonly used in financial planning. Use of technology, analytics, and AI in forecasting. Technology enables faster data processing, automation, and real-time updates. Data analytics identifies patterns and trends in large datasets. Artificial intelligence improves forecasting accuracy by learning from data and predicting behavior. Cloud systems enhance collaboration, while human oversight ensures realistic interpretation and ethical use of data. How to prepare forecasts step-by-step approach. Define the purpose of the forecast, gather relevant internal and external data, select appropriate forecasting methods, make assumptions clear and realistic, prepare calculations, conduct scenario and sensitivity analysis, review results for accuracy, and update forecasts regularly based on new information. Conclusion: business and financial forecasting helps organizations anticipate future outcomes, reduce uncertainty, and make informed decisions. By combining data, professional judgment, and technology, forecasting strengthens planning, improves resource allocation, and supports sustainable long-term performance. Thank you for watching. Subscribe for more informative content.